All right, welcome here to Market Call. That's MKT Call. I am Dan Nathan. I am joined by the illustrious Danny Moses. Danny Moses is the podcast partner of mine and Guy Adami's On the Tape podcast. That drops every Friday morning in your podcast store, so check it out. But again, this is Market Call. Just so you guys know, I did talk to Guy Adami this morning. He is in Sicily. He does miss you, and he had one word for some of our friends. Toggle. Okay. All right. We're going to later be joined by a guy that is kind of hit finance Twitter by storm. He's called Alf, but we like to refer to him as Alf Peccatiello. He writes the Macro Compass, and he is a brilliant macro mind. So stick around. Alf is going to be joining us in just a few minutes. Today's Market Call is brought to you by CME Group, where risk meets opportunity, and of course, our data partners FactSet, and we are powered by Open Exchange. So thank you guys for all being here. Danny Moses. This is it, baby. The moment of truth. Is it really the moment of truth? Okay, so CME Fed Funds Tracker pricing, about an 80% chance of a 75 basis point hike tomorrow when they come out with a Federal Open Market Committee comes out with their decision. It would be the third such 75 basis point hike in so many meetings here. Talk to us a little bit about that 20% chance that maybe they do a full percentage point.
Well, we'll be up to 300 basis points or 3% total raises since they began this back in the spring. What's really interesting to me is now when I look, I hadn't looked in about a week. Fed Fund futures now pricing in 4.25. I mean, so they're pricing in on top of this 75 basis points, Dan, another 1.25% by the Fed to year end. I mean, more than 50% chance of that. And if that's true, the stock market has no chance. And I don't think that's going to be true, because I do believe actually they're going to be done after this raise. If it's 1%, they're definitely done. If it's 75 basis points, I think they'll jawbone a little bit. But again, I'm more concerned with looking past that and the obsession with the Fed and every data point, inflation data point. We've traded in ranges of 10 to 15% on the market based upon one CPI print or a PPI print or retail sales. Meanwhile, behind the scenes, earnings are coming down for companies. And just looking at the PE multiples of what they could contract to, we can talk about that later, but that is much more concerning to me. And then lastly, I know we'll get into this with Alf, is that the global rates in general, it's not just us, it's everywhere. Yeah. So we've talked about this before. So I'm looking at a lot of things here, Dan, but we're going to quickly shift, I think, from the macro back towards the micro again, and that scares me a little bit.
Well, it's interesting that, after this meeting tomorrow is completed, there's not another meeting until November. And when you think about going to the micro, what's going to happen in October, we're going to have Q3 earnings, and it really is going to focus a lot on what companies' guidance are and the sort of visibility they have. And depending upon where rates go, with the absence of a Fed meeting, it's also going to weigh on valuations. But let's quickly talk about this 10-year U.S. Treasury yield. You see it's breaking out, Danny. And so here we're at levels that we haven't seen the 10-year in over a decade here. What is today's action in yields higher telling you about market participants and how they're positioning? I mean, it seems kind of obvious. I'm leading you a little bit, but it's kind of funny that we get the breakout today as the meeting starts.
Yeah, I want to say one other thing. So we do get, you don't have to value it or not, but we do get a dot plot every quarter. We're getting a dot plot tomorrow also. So we're going to see where the Fed and all their wisdom believes growth is going to be and all those things. So how they marry all that together. I just wanted to add that. I mean, listen, you are now having kind of what I believe is the kind of the blow off top here in the long end of the curve, so to speak. We are now, if you look, I mean, I don't think it's a coincidence that we're back to the levels when QE 1 and 2 were kind of beginning and ending, right? We're hitting those levels now, what we're doing. The 2-year yield, just to bring it back, is obviously more impacted by short-term what the Fed is going to do. And they're now projecting and matching up where Fed Fund futures have started to go. But I think this is a kind of a global kind of sell-off in bonds of what we're seeing. And the higher that it goes, it feeds on itself, because then it becomes a situation where what are the ability for these global banks to finance themselves, global sovereign wealth countries to finance themselves over time. And so we're kind of re-rating, again, not to preview what Alf's going to talk about. I know that's what he tweets about a lot, is that exact type stuff, the risk inherent there. So Dan, this is just, I think, just a kind of kitchen sink situation right now. I believe we'll talk about it. I think it's a buying opportunity on the long.
All right. Well, let's talk about that, because you said you think it's a blow off. So if we want to look at the inverse of the yields, if you look at the TLT, that's the ETF that tracks the 20-year U.S. Treasury bond, you see this thing. It's kind of fallen off the bottom right side of the chart. This is a 5-year chart going back to 2017 or so. Thoughts here on how to play this? I mean, we talked about it with Carter yesterday, because he kind of likes playing it for a bounce here. As far as vol and the ETF and the options, it's relatively cheap relative to a lot of other risk assets. So call spreads. Are you a buyer of the TLT here?
If you're not a buyer of the TLT here, then you're a seller of everything. What do I mean by that? If the TLT continues to trade off a cliff, and as you mentioned, it moves inversely to 10-year yields. If 10-year yields, I realize they've been to 5 or 6% before. That's not a new thing. But if they go here in a straight line, we're going to have a massive problem on our hands as it relates to the equity markets and how to value them from a risk premium perspective. So I'm a sucker for charts like this. When everybody hates something, I tend to like it. I do think we are set up for a bounce. I just don't see how the data that we're seeing from companies and inflation in general is moving down, moving lower, that we're all not on the same page, that we've seen the peak of inflation and I might mind you the peak in earnings. And with those two combined, I don't think our economy can survive with rates much higher than this. And when I say survive, that's a little dramatic. But you talk to getting the 4.5%, 5% range to finance. We've already seen the impact on housing. We've seen the impact on bonds. We've seen the impact, corporate borrowings. And so I just think it becomes self-fulfilling that this has to be a buy here. So.
All right. Well, here's somebody, Nouriel Roubini. You know him. You love him. He was quoted earlier this morning saying he sees stocks sinking 40% in the U.S. in a long, ugly recession. Dan Loeb, hedge fund extraordinaire, billionaire, Third Point, says echoes of 2009 near the market bottom from my friend. I think he's being sarcastic there at Nouriel, who made a similar prescient call a few days after the market bottomed here. What do you make of that little exchange?
Well, I'm a big fan of Nouriel. I mean, we used him a lot back in the financial crisis. He would come into the office, Turkey disaster, Italy disaster, France disaster, Germany disaster, disaster. So he gets carried away. But listen, this guy's seen a lot of cycles, and so he knows it seems like it's easy to pile on here on the bear trade, but people should listen. He's not talking his book, so to speak. He's talking what he sees happening in the macro. So listen, everybody innately wants to be optimistic and be bullish. I mean, that's how we are, right? That's how we're set up. You want to see the bright, the positive in things. I just don't see how we're going to get through this, one, in a soft landing, and two, without a lot more volatility to come between now and when the realization of kind of the Fed has finally finished its job here. So, I can see both sides, but I do value Nouriel. So.
All right. Well, there you go. Okay. I just do think it's interesting that Dan Loeb, who probably is a bit of a contrarian also in his investing, taking a shot there at Nouriel. I guess he's an easy target at this point. He's got one pitch. Let's look at the S&P 500, because you said just something before, lights out if yields are, or you said the economy can't make it in this environment. It's going to be lights out for stocks if we see yields up at that 4.25 Fed funds, what the Fed funds futures are targeting here. You look at this chart. Again, it's a series of lower highs. We saw what happened from the June lows. We had a couple bounces. We had a little bit of an uptrend there. We just broke it on Friday here. Pretty important technical break here. And I think it's probably something where it's going to be a hard trade. Like, if the lower we go today into tomorrow's announcement is the more likely we probably get an initial snapback. But again, based on some of the other things we're going to talk about, it really does feel like you sell rallies here. The charts are helpful, until a point, because right now, I mean, there's a lot of room back up to that downtrend, which is like 4150 or so. But thoughts on the S&P 500, at least from a technical perspective right here, Danny?
Yeah, I think you just nailed it. I think you could see a huge rally into what I believe will be the acknowledgement by the Fed that things are slowing. They can't not acknowledge it, right? That they're seeing signs of slowing. They're going to try to maintain some type of credibility and still say we still believe inflation is a problem, et cetera. So I think you'll get the excuse to trade higher, but I actually believe that's why we're not lower now. So I think we were already past this point. The markets will be lower from here. Again, there's going to be bargains. There'll be single stocks to own and so forth. But just looking at that chart, I think you could see a 200-point range tomorrow in the S&P. If you want to get really crazy, you could see up 100, down 100 type situation. But again, looking beyond that, how you're positioned, I pay attention to single names tomorrow on exactly making a list of the things that you want to sell if you get a little pop, and the things that you want to buy if you get a big type of drawdown. So
yeah,
I think that chart says it all, Dan, that nobody knows.
All right. Well, here's one chart. This is the chart of the gold futures here, Danny. We've talked about this a little bit. And listen, people who are trading gold right now, they kind of believe that the back has broken of inflation, because there's no way this thing is making, 1.5-year lows, down considerably from those highs just made earlier this year. If you believe that inflation is going to be, a rampant problem for the balance of this year. Talk to me a little bit about this chart, because again, that's a really important technical level, and there's not a whole heck of a lot of support. I don't know, maybe for another 100 points in the futures here.
I mean, on a relative basis, I guess it's been fine. On an absolute basis, it hasn't done what it's supposed to do. To your point, Dan, it's supposed to work in an inflationary environment. A lot of cross currents here for gold. I think you're seeing demand for the use of the actual industrial use of gold go down in China and India and the like. And I think you're seeing certain global central banks that are forced to sell some of this, for dollars, so to speak. So, and then obviously the strong dollar has an impact. All that being said, if you are positive on the equity markets, you have to believe at this point that the Fed is basically almost done, right? Or that they're going to turn a little bit or make that pivot. If that happens, it's hard for me to see gold not working. Again, sucker for a chart like this as well. I'm still there. I think people that think they're going to buy gold when the time comes are going to miss it. That's what this market has been. Max pain everywhere. Long side, short side, timing wise, you never get a chance. So I'll take my chances of being long gold here. I know that chart could certainly pick a direction, but I'm a buyer on any weakness, and I would own it into the Fed tomorrow. And if you told me that the S&P is going to be up 2 to 3%, I say gold's up 5% tomorrow. So,
wow, I would take the other side of that, to be honest with you. I think if the S&P is up 2 to 3%, I think gold's down 2 to 3%. But that's what makes a market.
We'll save that for another day, Dan.
All right, we'll say that. All right, listen, let's stick with the macro here. We got a bunch of stuff on the stock market that we'll hit, but I really want to bring Alf in right now. So as I said before, Alf is the he's the author of the Macro Compass. He is a great follow on Twitter here, people. And I think you can see up on the board right there, he is at Macro Alf. Alf, thanks for joining us, man. We really appreciate it. Danny and I and Guy, we are big fans of your work. And I just we want to introduce you. You have a huge following on Twitter. So I'm assuming that a lot of people who watch us, listen to us, they know who you are here a little bit. But tell us a little bit about, you just came on to the FinTwit stage a little bit. You're taking it by storm. You have a huge following. I think I read, I don't even know how many followers you have on the Macro Compass, your newsletter. Where'd you come from, buddy?
And then it's a pleasure to be here on MKT. Thank you for inviting me, and thanks for the kind words.
Of course.
I came from the boring European banking industry, like that. So I was running money for ING. It's a large European bank, but it's a global bank, actually. It's in the US and Australia as well. And I did that until December 2021. Basically, I grew tired of effectively, running mandate and making money for a bank, but not being able, because of compliance issues, to actually share the knowledge I've accumulated. I was lucky enough to accumulate with market experience with people. And that's what I wanted to do at the end of the day. So I decided it was about time to take the leap of faith and give it a try, see what happens. And Twitter, but also the Macro Compass, especially the newsletter, have rewarded me big times. And I'm not sure what exactly is resonating with all people, but I'm happy if I'm helping somebody to enhance their market IQ, let's say.
Well, you certainly have with us, and I will say this. I mean, how succinct you are about markets. There's really not a lot of bent. It doesn't seem like that you are kind of have an axe to grind. You're not talking your book. You're really kind of expressing a lot of views through the lens in which you operated at that large bank and trading those risk assets. So we really appreciate it, and it's really our pleasure to have you here. Let's talk a little bit about this environment that we're in, and I really would love to hear you and Danny go back and forth a little bit about this, but talk to us about the setup into this meeting. And, Danny just said something that, again, I think is really important. Maybe in the next week or so, we can stop obsessing over every little data point that we think the Fed might be interpreting. Talk to us a little bit about your view right now into this meeting, what you think is going to happen.
Yeah, so the big picture, guys, from my perspective, is that I look at macro and asset classes through the lens of two axes. One is what's going on in the real economy and in earnings, and the other one is what's going on in the monetary policy stance, let's say, which are also the driver of the Macro Compass on the two axes, right? The x-axis and the y-axis. So when I look at that, I see all the forward-looking macro indicators, and top of all, my global macro credit impulse, so the G5 credit impulse, which measures the pace of money being thrown at us, the private sector, the real economy. I saw that slowing down. I see all the other forward-looking macro indicators slowing down pretty aggressively. And that's one lens to look at it. The global economy is slowing down pretty hard, and it showed already signs of slowing down in basically the second half of last year already. And it's now unfolding, and the energy crisis is making it more complicated in places like Europe or the UK, for instance. The other thing I see is that never like today, I have experienced central bankers being so committed in tightening financial conditions. It's never been the case. They have, in 2018, there was a balance where they want to try to tighten financial conditions to slow down demand a little bit. In 2013, 14, there was a similar approach, but today it's completely different. It's mission number 1, 2, 3, 4, and 5 is to bring down inflation, killing demand. And there was a lot of criticism at the beginning of the year that, they're going to try and kill demand, although demand is responsible only for a small portion of inflation. That criticism was never close to me because I had the luxury of speaking to these policymakers and central bankers when I was running money. You realize that their incentive scheme is really skewed towards preserving credibility. And it doesn't matter at some point if they have one big hammer that can just hit everything as long as they achieve their objective, which is to anchor inflation expectations and bring the damn inflation down. There is no room for nuance at some point where inflation starts going at 5 or 6%. So they are tightening financial conditions by basically eating every single component of the financial condition index. So it was the turn of the dollar, then it was the turn of credit spreads at some point, then equity valuations, and now it's real rates. If you see what's going on in real rates across the curve, from the front end all the way to the back end, and the pace of change in this increase in real yields, it's really, really large. And that is the second way I tend to look at the macro today. The combination of a slowing economic growth and central banks ultra committed in tightening financial conditions makes it for a very complicated environment for beta return harvesting, which has been the name of the game between basically 2014 and 2020.
So, wow, if people have a short memory, or people that lived through it like you and I and Dan, 2008, 9, 10, 11, remember, started here in the US, worked its way into Europe. And I think people forget, the banks would have gone, the banks in Europe did go off a cliff, but sovereign would have gone off a cliff as well. But obviously we came in, global central banks came in and started buying paper. Well, there's two sides to this, right? There's the tightening financial conditions, and then there's lack of QE, and or in the case of the US, QT, which is beginning. And I think people don't understand how these countries like Italy, who 10-year yields are now ballooning, it's not lost some of the irony that Draghi is stepping down when he was just print guy, obviously in Europe, and he leaves his position in Italy. So talk a little bit about the understanding of kind of this normalization of rates, because I think we have a short memory that we forget that what was happening in Europe in 11, 12, 13, 14, and how this is just quickly, to your point, unwinding here. So maybe comment on that if you don't mind.
Make a distinction, Danny, and thanks for the good question, between the private and the public sector. So people tend to always obsess about government debt to GDP, but I think they're actually missing the big picture, which is that the private sector is much more in trouble from a systematic perspective because corporates, households can't print money to refinance their liabilities. We can't. If you want to refinance your mortgage, the only way you have to, if you have double interest rates compared to before the pandemic, is to have a bigger salary or to sacrifice more of your disposable income into interest payments. And the same goes for corporates, right? And if I look at the US, for instance, I see about $40 trillion of private debt sitting on corporate's balance sheet. Then when measured against asset values, seems okay because those asset prices were inflated. So looking at stuff like net debt or liabilities against assets make the picture look very good. But looking at liabilities of the private sector, wow, try to refinance all of those at corporate yields, which are more than double they were before the pandemic. And same goes for mortgage rates. So that's the first angle. And I think the private sector is pretty much in trouble when it comes to refinancing across the board. You see that on junk corporate bond issuance this year, which is something I track. It's the lowest year to date on record since 2008. There is basically no junk corporate that can afford refinancing their business model at today's yields, which have skyrocketed as a combination of risk-free rates, so treasury yields that have gone up, and credit spreads that have widened. I can make the same case for households and mortgages. who can afford mortgage payments, which are basically 70% higher than they were before the pandemic, buying the median house today, because median house prices have gone up and mortgage rates have gone up at the same time. The public sector, in Europe especially, Danny, to answer your question and talking about Italy. So the situation is pretty simple. The architecture of the Eurozone is pretty poor by definition, because you have one monetary policy authority for 19 different jurisdictions that need different monetary policy and different fiscal policy to thrive. So the architecture itself is very fragile. And every time you have an exogenous shock of some sorts, there is always a release valve in such an architecture. And so far, the release valve for the external energy shock has been the euro until now. And the euro has been the release valve because, well, terms of trade are terrible once energy imports more than double compared to they were before the pandemic. And clearly, central banks' hiking cycle can do only this little when you measure euro against other jurisdictions whose central banks are also hiking, and when you have an exogenous shock you can't solve by raising interest rates, which is the energy import problem. That's so far. Now, so far, basically the euro has been the release valve. The other obvious release valve is weak sovereigns, weak credits, let's say. And you normally wouldn't call a sovereign a credit in the first place, but in Europe you have to. You have to, because Italy does not have the power, the fiscal power, to print money at its own will to refinance its liability, nor has a domestic central bank that would support it unilaterally if needed. So when basically weak sovereigns, weak credits in Europe are a rates product as long as things are fine, they become a credit when things are not fine. And that's what's about to happen right now. By the way, don't forget Italian elections, which are this weekend, and good luck with that.
Yeah. Well, let's bring it back over here for a sec, Alf, because, a lot of our listeners, a lot of our viewers are very focused on, obviously, the U.S. stock market. And, Danny is really, and it's great to get your perspective because, again, you're talking about events outside the U.S. and there's stuff that's been going on that have been affecting the dollar, have been affecting commodities, have been affecting rates and the differentials and that sort of thing. But, what do you think the breaking point here is in the U.S., at least for when I think about the macro landscape? I think of stocks that are down, but not down nearly as much as they were a few months ago. Valuations are still high. Rates are the highest that they've been in a very long time. Inflation, measured by CPI and other measures at, 30, 40-year highs, right? What do you think the breaking point here is? And is there a potential for a soft landing? Can this U.S. Federal Reserve kind of nail the landing? Because Danny just said Fed Fund futures now are still pricing about 4.25%, right, by the end of the year, which seems insane. We haven't seen that in 2 decades.
The answer is no. They can't nail it. It's very simple. You cannot raise borrowing costs this much, this quick, and you cannot have this pace of change in financial conditions. And on top of it now, the second dimension is keeping monetary policy so tight for so long as the Federal Reserve and the Eurodollar market are pricing in an over-leveraged economy that has been structurally weakened by a pandemic. I'm sorry, but it doesn't square. And the fact that it doesn't square, it's visible as well, if you ask me, in forward-looking macro indicators, and will be visible in earnings. Today, we got the very first downward, basically adjustment to 2022 S&P EPS. They've been revised down. 2023 EPS are being revised down, earnings per share in the S&P 500. Yep. This trend is only to accelerate, if you ask me. Now, when it comes to the bond market pricing then, which is my home turf, let's say, the fixed income market. So there's been basically a twofold story so far. The first half of the year was all about the Fed trying to tell us that, hey guys, we have an inflation problem. You can't price us hiking at neutral rate, whatever the estimate was, 2.5%. That doesn't make sense, because to lower inflation, we need to be tighter than neutral. So please, could you trust us that we're going to really be serious about inflation? Can you price this damn terminal rate all the way up to 3.5%? That was basically the first leg of the Fed, of the Powell attempt at sounding serious about inflation. Okay, he got that. The moment he got that, 1 year forward Fed funds future were priced 80 basis points lower. So the market was like, yeah, you're going to get there, and then you're going to cut, because obviously you are not really serious about inflation. You're only trying to shock and awe the market, basically, but you're going to be cutting. The second leg, which was really augmented with the Jackson Hole speech, was all about taking these 1 year forward Fed funds, basically the Fed funds future price between, say, September 23 and March 24, and push them up. It was the higher for longer story, effectively. that the market didn't really want to buy at the very beginning, but the Jackson Hole speech was extremely strong. It was the shortest, most direct speech that I've ever heard in Jackson Hole, which is, by the way, not really a theater for this kind of strong monetary policy speech. It's more of an academic setup. So where he did it, how short he did it, how convincingly he did it, convinced the market to price that one higher. The third leg we're seeing right now is just the bond market. I love that because I used to be one of the guys taking risks in bonds in pretty large size. What we tend to do is, okay, now you're telling us you're very serious about inflation. Sure. Now we're going to challenge you to see how really we can push this pricing in the front end until you come out and you say you're uncomfortable with us pricing a terminal rate of 4.5%, 5%, because things are going too far. Now, the moment Powell comes out and challenges that view, is basically loosening financial conditions. He's saying, no, guys, that's too much. I'm not serious about inflation. I won't do that. So right now, it's the bond market challenging Powell at the front end, where the Federal Reserve has the ability to really follow up on bond market pricing if they want to. At the back end, you're seeing some weird stuff going on. Two stands, 530s, all these curves are as inverted as they can be. They will get more inverted, if you ask me. The more the Fed tightens at the front end, the more damage it will do to long-term economic growth.
Yeah. Alf, I got one last question here. Yeah. Sorry, it was one last question, Alf, just in terms of the U.S. So the argument to be bullish on U.S. equities is that it's the sexiest game in town globally. Forget about valuation for a second. But, all these things that are going on, I don't think we really appreciate currencies and global bonds and all those things. And so there's going to be a point here where we have to start to recognize the impact that multinationals are going to feel, obviously, borrowing rates in Europe, purchasing power diminishing globally. Is it the U.S. dollar? And then I know we got hot, but is it the U.S. dollar here that is the biggest focus of what you'll be watching as a sign for either more volatility to come or a little bit less?
Well, Danny, what you say is extremely smart. I always try to have a global lens. And the global lens this time brings me to Switzerland. You'd be like, what are you talking about? All right. So Switzerland between 2010 and 2020 has accumulated $1 trillion in FX reserves. It's $1 trillion. So $1 trillion, which has been invested not only in bonds, but also in stocks. So basically, the Swiss National Bank became the biggest hedge fund in the world, if you wish. And they've bought as many NASDAQs and S&Ps as they can, right? But that's because they've been accumulating dollars to try and stem the Swiss franc from appreciating. So in a disinflationary world, what you try to do if you have a very strong currency is to stop the currency going up. So you try to basically sell the currency and buy dollar assets with it or European assets with it, right? So that's what you try to do. And today, the Swiss National Bank, like many other external jurisdictions, are trying to do exactly the opposite. The Swiss National Bank, if you ask me today, together with maybe companies in Japan, are looking at the exact opposite situation where they want their currency to actually appreciate, not depreciate. Because the more it depreciates, the more it pushes up local inflation, which they don't want because it's already higher than their targets. So you're having the opposite global setup where instead of foreigners buying and pushing money into European and US assets, they're doing the opposite this time, right? So that's a change of scenery. That also has an impact on the dollar, obviously, but the dollar there's always a timing consistency when we talk about the dollar. So in a deleveraging episode that we are seeing right now, where global trades are slowing down, where leveraging is becoming basically impossible for many companies, where the biggest single asset class in the entire world, the Chinese real estate market, the $50 trillion market cap at the end of 2021, it's biggest than the US stock market, actually is deleveraging at a very fast pace. When you see this deleveraging, the dollar, which is the denominator of most things we trade with, most goods we exchange, most commodities we exchange, actually tends to get a bit. Because companies have basically increased their dollar liabilities over the last 15 years. We have trillions in dollar-denominated debt from jurisdictions that have no access to dollars. If not for these trades, for this economic growth, for this global growth, they are in trouble. So there is a dash for dollars. So short term, the deleveraging episode pushes up the dollar. That's what we're seeing now. Long term, there are other cross currents like diversification of FX reserves out of treasuries and US assets and European assets into gold. It's a slow grinding process that will take time, but there is always a timing consistency when you analyze the dollar. So short term, we're going higher under the deleveraging. long term, we might want to reassess the situation because of these cross currents you're talking about.
Yeah. Well, in the near term, I really feel like, and Danny and I are going to talk about this in a couple minutes with some single names. It's just going to wreak havoc on earnings. And you just kind of mentioned that too, Al, for U.S. multinationals, given their exposure overseas, and also given the weak demand that there's so much focus on the U.S. consumer when you think about China and just the reverberations of their continued lockdowns and what's going on in Europe. So again, I think that's going to be a Q4 story for U.S. multinationals. Listen, Alf, we really appreciate you joining us. We hope that you will come back. That's Alf Peccatiello. He is the author of the Macro Compass. You can find him on Twitter at Macro Alf. I suspect many of you already do. Alf, thanks a lot for joining us, bud.
And then it's been a pleasure. Thank you for having me.
Thank you, Al.
Thanks, bud. Okay, that was awesome, man. That guy, he is one smart guy, and he's got a better Noriel accent than you do, Danny. Just so you know. All right, let's rip through some stuff here because I want to hit. He really, I think the takeaway for the stock market was basically we are going to see earnings revisions. We've been talking about it on the tape on Market Call for a very long time. We had peak margins here in the U.S. last year. When I say peak, I mean literally all-time highs, and they basically started to kind of show some signs that they're coming down. And again, that's going to lead to earnings revisions. Danny, you had a tweet thread yesterday. You don't tweet often, but when you do, it's pretty darn good. Lots of positioning ahead of Fed meeting on Wednesday. Walmart gave the Fed the heads up ahead of the July meeting, and FedEx just did the same for this meeting. Talk to me about this whole thread and why you thought about it and what you think comes next. And we're going to hit some single names also after this. And I think there's other companies who are kind of winking at this same sort of thought process.
Yeah, it felt like Walmart back in July certainly did that for the sole purpose of the Fed seeing it. FedEx kind of feels the same, although it was about 5 days before, so maybe not exact. But either way, if the Fed's not paying attention to two of the largest U.S.-based companies out there, then they're not doing their job because, again, pull their head out of the sand. So to me, it's obvious. I don't need economic data points, as I just mentioned before. I'll take it from corporations that have traded through many, many cycles that see. And that was kind of, to me, FedEx throwing in the kitchen sink there. So that was that. Now, beyond that, which I just talked about when we started the show today, is that's the stuff we need to start to focus on. The impact that rates have, or the impact that global sentiment have on specific companies, because at the end of the day, that's what makes up the S&P 500. That's what you have to get right. You got to not just get earnings trends right, but the depth of the earnings moves lower and potentially higher. So again, that's what I like to look at. The Fed stuff is just noise to me because the impact is being seen,
Yeah. Well, I mean, just again, here's two headlines. We've been talking about it for months and months, and maybe we were just early, and we know that we tend to be a bit early, but here's a headline today from Goldman Sachs: shrinking margins could spell trouble for stock market returns. We know that. And then BlackRock saying earnings cuts are coming for stocks here. So again, I think that's pretty interesting. We do see that expectations for margins tend to be up right now. The S&P 500, that's not happening. And just overnight, I mean, you saw what Ford did here, Danny. Talk to me a little bit about this. This stock is down more than 10% on a really weak guide. They're talking about production issues here. This is from Street Accounts, just kind of reviewing this a little bit. And you see this one-year chart that we just overlaid that data on here, man. This is some nasty business here, because if you back it down to the 5-year, you look at those June lows and you're just above $10. There's still a ways to go. And I guess the key point I just say here, Danny, is that companies like Ford and GM, they're kind of eking some of this news out little by little here, but sooner or later, there's going to be some sort of kind of just disastrous, forward year guidance that's going to come out, and it's going to reset the tables. And if you're going to be responsible, at least if you're going to continue to give guidance, you probably want to just get the worst out of the way and really set the bar low enough where you can start beating again. Talk to me a little bit about that.
Well, it's amazing how certain auto companies are impacted by CapEx and problems with supply, and others aren't. We'll get to that in another show. But what's interesting is that you remember Ford has a very large finance arm, right?
Yeah.
Ford finances people into their cars, right? They manage a credit book. It's fine right now, but that is an issue. That is a headwind, I think, that's going to come. So there's two things there, right? If you're a company that has a balance sheet like that provides credit, that hurts you both ways when the market turns and rates move higher, right? Because obviously cost of financing goes up, your credit turns a little bit down. So I'd have to go looking forward at how much money they've been making from the financing division, what the credit reserves look like. I'm sure they're fine right now in terms of how much they have reserved. But Dan, it'll quickly shift from supply issues and how many cars you're selling to what does your credit look like? I mean, let's not forget that we bailed out the auto companies, right? Back in 2008, 9, when all this stuff was happening the first time, and credit was the main reason. It had nothing to do with supply shortages. So I haven't done enough bottom-up work on those companies in particular. But again, it's common sense that these would have some type of impact. And Dan, I'll say it again: companies don't just pre-announce once. When this is a very secular thing. It's not cyclical to me in nature. So will they get through it? Yes. Are they going bankrupt? No. Be fine. But what is the value? Tell me what earnings are going to be in 23 and 24, which is anyone's guess at this point.
Yeah. Well, to your point, last week we had the big kahuna. We had FedEx. That was just a disaster. Then we had GE, and now we have Ford, and there's going to be many more in the next couple, probably days into the quarter end here, and probably the days after the quarter. Another one I thought was kind of interesting. Again, this is a combination of production issues and demand issues. I mean, Nike was downgraded at Barclays. This is per street accounts. Look at this chart here. This looks a lot like if you were watching yesterday, Carter had that whole kind of chart, I guess, presentation about a bunch of names that looked like about ready to kind of break those June lows, and maybe they hold and make double bottoms. His presumption is that they don't. There's too many of them that look the same. Look at this thing, that nice round number of 100. And then if you back this thing out 5 years and you look how important from the pre-pandemic highs to that kind of breakout level in late 2020, you see that this $100 level is a really big level here. It's just worth keeping an eye on that. This is a company that I would not be surprised. They have a mulligan. They can go out there and say they're having production and demand issues. They're having issues with the dollar. A lot of their sales come from outside the U.S. Danny, do you agree with that? U.S. multinationals are really going to have a hard time because the dollar, which did come back a little bit earlier this month, seems to be right back near its highs.
Yes, I think Nike's a perfect example. Great company, incredible brand, not going anywhere, will be around, but it's going to have its price. That chart doesn't look great. It could certainly go lower. That's the name you probably put on your list that you want to own, but it's still expensive, Dan, to your point. They're giving you, they're projecting, or at least the analysts are projecting, that numbers are going to be coming down. So what kind of price earnings multiple do you put on a company like that that's got a great franchise? We know there are issues in Asia, right? We know global demand, and you just touched on what I've been talking about is U.S. multinationals with the dollar strength it's been it's just math. They're going to have issues here. So there's many of quote charts that look like that. There's many other Nikes out look. It doesn't mean they're not a great company. I think you just got to find the price. And again, this is how people make their money, right? Is trying to figure this thing out. So they're not alone.
So no, I agree with you. All right, last thing here. Here's a couple of tweets from a guy named Mike Zaccardi. He's a good follow on Twitter. I follow him. I get a lot of good data from him. This was interesting. This was from a couple weeks ago. The PE ratio, the S&P 490 is 14.6. So he's basically backing out the top 10 holdings in the S&P 500 that traded about 25 times current, and then you back out the 490, and they are basically well in value territory. It's just those 10 that make up the highest percentage of the top 10, I think, ever. And this is in this other tweet, and they're nearly 30% of the weight of the index of 500 stocks. Again, it feels like the whole entire market, Danny, is waiting for these top stocks, these top 4 or 5, just to break here. Here's Microsoft. I think this is probably one of the most important charts in the market. 240 is the level. It's down 1.5% today. It's trading right there. You see that level backed out going back a year. I look at Apple and I say it's still well above those June lows. If this thing joins the party and starts to retest those June lows, watch out below. Alphabet, he highlighted yesterday, this one about to break and make new 52-week lows. And then Amazon had a huge bounce. But again, if that were to go back to the June lows, Danny, thoughts on the concentration of those names? And is this it? Is this all we're waiting for to happen? Because without these stocks, I mean, think about it. There's just this market is just a mess if all 4 of those are making new 52-week lows.
You just described the biggest problem in this market, which I've talked about for months, is active versus passive. Passive investing is what has caused that skew to occur. Money flowing into Qs and SPYs and all these ETFs, it's become self-fulfilling that those names will be the highest weight, right? Over time, they'll grow over time. So to me, it's going to be a stock picker's market. It is a stock picker's market. You own those names because you feel safe in them because they're quality, but that's a great point that you bring up and a great chart. And that tells you that when the SPY and when the Qs, when all these things do sell off, there'll be names that are trading at 9 to 10 times probably earnings that are just getting thrown in, right? That didn't get the benefit of all the flows on the way up, and they're going to get hammered on the way down. And that's what that tells me, Dan. And everything's going to have its price, and we're going to be okay. We're going to get through this. I'm just nervous that there's a big washout coming here that's going to present tremendous opportunity, to be frank. So, but that's what that tells me.
Yeah, it does. All right, my man. Well, I appreciate that. That was a lot of fun. We got to meet Al face to face. He is a really bright guy, man, and a great follow on Twitter. So check out the Macro Compass. I've been reading it now for a while, as soon as I kind of came on to him. So that one's really interesting. Danny Moses, really appreciate you joining me on Market Call. We are going to be in face to face. We're going to be in person on Thursday with Stuart Sopp of Current. We're going to break down what the Fed said and how we're positioning a little bit here. I'll just say this, as we've been talking, earlier in the day, Apple was up almost 2% and everything else on my board was pretty much red, Danny, and this thing feels like it's about to go lower. I actually bought some weekly 155 puts in this thing. I paid about $2.20. So I'm looking for this thing to go at least to 152.80 by Friday's close. That's how I'm trading the Apple here. I really feel like this thing could catch some steam to the downside. I'll just say one last point. And always, especially when I'm trading short-term, weekly directional options like this, I use a very hard mental stop of 50% of the premium that I paid. I do not want to see things like this go to zero. So that's my little trade of the day right there on Apple. Maybe I see 150 or a retest of those lows by the end of the week. So Danny, thanks for joining me.
Thanks for having me.
All right, buddy. I'll see you on Thursday. Thanks. Yeah. Thanks, everyone. All right. And again, thank you to CME Group, our sponsor here, Open Exchange, for powering us. And of course, thanks to FactSet for all those nifty charts and all that data and all the stuff from Street Accounts. So thanks again, FactSet. Thanks, CME. We will see you tomorrow. I will be back with Tan Sosnoff from Tasty Trade at 1 o'clock. And we also have Liz Young from SoFi is going to be joining us. So check it out. This is going to be the pre-Fedapalooza event. Market Call. Thanks. Bye.